Hi everyone, and welcome back to ACCA 4 revision. So we're going to pick it from where we stopped. This is revision session 2. So based on our study planner, we would have to be looking at hedging currency and interest rate risk. So first, we're going to look at cocoa mocha charcoal, June 2014, question number 1. It's a 50 marker question, and obviously it's expected to be big. And then we also look at R1 code, December 2013, question number 2. So the first one is a combination of currency hedge and then interest rate hedge. And then the second one is in relation to of only interest rate. So when you have time and you want to practice, hedging is there almost every sitting. So you can also go ahead and practice with Llama PLC, FNDC PLC, and Electrical. All of them are in your revision kit, so you can practice on them. Any questions that you have about them, of course, you can forward them to me and I'll be very happy to answer them for you. So we're going straight to the first question, which is cocoa mocha chai co, June 2014, question number 1. So let me bring it up. June 2014, question number 1. And this is that big question. As usual, our strategy is that when we go to the exam room and we've got a question, we would have to read from the scenario. We have to read the requirement first. And having got the requirement analyzed, we come to the scenario and then we read, we indicate the necessary information from each paragraph, so that when we have to solve the requirement, we know exactly where to go and pick what information for that. So let's go straight to the requirement. I read the requirement, we analyze it, and then we move from there. Required: A. Advise CMC Co. on an appropriate hedging strategy to manage the foreign exchange exposure of the US dollar payment in 4 months' time. Show all relevant calculations, including the number of contracts bought or sold in the exchange traded derivative market. 15 marks. According to this question, we should advise on the appropriate hedging strategy to manage the foreign exchange exposure of the US dollar payment in 4 months' time. Show all relevant calculations, including the number of contracts bought or sold in the exchange traded derivative market. So when I go to the scenario, because the requirement is to come out with appropriate hedging strategy, I know if it is currency, there are so many different hedging strategies that could be used. Forward contract, money market, futures, options, swaps, and all that. So which one has the examiner given me the necessary information that I can use as a way of protecting against my exposure? According to the requirement, the exposure is the US dollar payment, which implies to be paid in 4 months' time. So when I go to the scenario 2, I should be able to identify what dollar payment is supposed to be made in 4 months' time. And I need to show all the calculations. So that is that. The B is demonstrate how CMC Co. could benefit from the swap offered by Pecunia Bank. So the analysis straightforward here is what will be the benefit CMC Co. can get from the swap offered by Pecunia Bank. So when I go to the question equally, I am going to look out for what swap arrangement has been offered by this peculiar bank, and that is the 6 marks. The C is saying, as an alternative to paying the principal on the loan as one lump sum at the end of the 4th year, CMC Co. could pay off the loan in equal annual amounts over the 4 years, similar to an annuity. In this case, an annual interest rate of 2% would be payable, which is the same as the loan's gross redemption yield. Yield to maturity. Required, calculate the modified duration of the loan if it is repaid in equal amount, and explain how duration can be used to measure the sensitivity of the loan to changes in interest rate. Straightforward. I will need to come out with the duration. Straightforward question said I should calculate the modified duration. So that is the first bit of the question, and I have to explain how I can use that duration to measure the sensitivity of a loan to changes in interest rate. So 2 questions in one. Then D is to prepare a memorandum for the board of directors of CMC Co., which I discusses proposal 1 in light of the concerns raised by the non-executive directors, and discuss the agency issues related to proposal 2 and how these can be mitigated. So that is 9 marks. Professional marks always is 4 marks. The report is in relation to only requirement D. So A, B, and C is a free thing that I can do, but when I come to the D, that is where it should follow a report format. So let's go to the scenario. I need to get the US dollar payment that is supposed to be paid within 4 months, and then what hedging strategies I can use. I have to also look at the swap offered by Pecunia Bank. I have to calculate duration. I have to look at the proposal 1, and then in line with the non-executive director's comment, and then also the agency issues. So that is the requirement. So when I go to the scenario, we need information to analyze or answer that question. So I read the scenario. As usual, indicate whenever there is the need for any information relevant for a question, you indicate paragraph by paragraph. So let's go. Cocoa Mocha Charles CMC Co. is a large listed company based in Switzerland and uses Swiss franc as its currency. It imports tea, coffee, and cocoa from countries around the world and sells its blended product to supermarkets and large retailers worldwide. The company has production facilities located in 2 European ports where raw materials are brought for processing and from where finished products are shipped out. All raw material purchases are paid for in US dollars, whilst all sales are invoiced in Swiss francs CHF. Until recently, CMC Co. had no intention of hedging its foreign currency exposures, interest rate exposures, or commodity price fluctuations, and stated this intent in its annual report. However, after consultations with senior and middle managers, the company's new board of directors has been reviewing its risk management and operation strategies. The following 2 proposals have been put forward by the board for further consideration. Proposal 1, setting up a treasury function to manage the foreign currency and interest rate exposures but not commodity price fluctuations using derivative products. The treasury function will be headed by the finance director, the purchasing director who initiated the idea of having a treasury function was of the opinion that this will enable her management team to make better decisions. The finance director also supported the idea as he felt this would increase his influence on the board and strengthen his case for an increase in his remuneration. In order to assist in the further consideration of this proposal, the board wants you to use the following upcoming foreign currency and interest rate exposures to demonstrate how they would be managed by the treasury function. 1. A payment of $5.06 million, which is due in 4 months' time. Something is clicking. Something is clicking here. I need to hedge dollar payment in 4 months' time, and that dollar payment is what is here. So I will say this is my dollar exposure. I put it in there. Then a 4-year $60 million loan taken out to part fund the setting up of 4 branches. See proposal 2 below. Interest will be payable on the loan at a fixed annual rate of 2.2% or a floating annual rate based on the yield curve rate plus 0.4%. The loan's principal amount will be repayable in full at the end of the 4th year. So this is the loan and its interest. Proposal 2. This proposal suggests setting up 4 new branches in 4 different countries. Each branch would have its own production facilities and sales terms. As a consequence of this, one of the 2 European-based production facilities will be closed. Initial cost-benefit analysis indicated that this will reduce costs related to production, distribution, and logistics, as these branches would be closer to the sources of raw materials and also the customers. The operations and sales directors supported the proposal, as in addition to above, this would enable sales and marketing teams in the branches to respond to any changes in nearby market more quickly. The branches would be controlled and staffed by the local population in those countries. However, some members of the board expressed concern that such a move will create agency issue between CMC Co. central management and the management controlling the branches. The question said we should look at agency issues, so I will indicate. They suggested mitigation strategies will need to be established to minimize these issues. Response from the non-executive directors. When the proposals were put to the non-executive directors, they indicated that they were broadly supportive of the second proposal if the financial benefit outweighed the cost of setting up and running the 4 branches. However, they felt that they could not support the first proposal, as this will reduce shareholder value because the costs related to undertaking the proposal are likely to outweigh the benefit. Additional information relating to proposal 1. The current spot rate is $1.0635 per CHF. The current annual inflation rate in the USA is 3 times higher than Switzerland. The following derivative products are available to CMC Co. to manage the exposures of the US dollar payment and the interest on the loan. Exchange traded currency futures. I have to hedge using futures here. So futures is 1. The heading is there, so there's no need for me to write it. Contract size 125,000 CHF. Price quotation dollar per CHF. 3-month expiry, 6-month expiry. Exchange traded options. Contract size 125. Exercise price quotation dollar per CHF. Premium cent per CHF. Call option put option, exercise price 3 month expiry, 6 months expiry, it can be assumed that futures and options contract expire at the end of the month, and transaction costs related to these can be ignored. Over-the-counter product. In addition to the exchange-traded product, Pecunia Bank is willing to offer the following over-the-counter derivative product to CMC Co. A forward rate between the US dollar and the CHF of $1.0677 per the CHF. So this is also forward contract. An interest rate swap. So this is where the swap agreement is. Contract with a counterparty, where the counterparty can borrow at an annual floating rate based on the yield curve rate plus 0.8%, or an annual fixed rate of 3.8%. Pecunia Bank will charge a fee of 20 basis points each to act as the intermediary of the swap. Both parties will benefit equally from the swap contract. Okay, so that is the scenario. The A is saying we should calculate or come out with a hedging strategy of how to protect against the dollar payment in 4 months' time. So based on this question scenario, we have realized that our dollar exposure is to make a payment of 50-60 in 4 months' time. And what hedging strategies can we use as a way of managing this? If I come to the question, I see currency futures, I see currency options, I see what? Forward contract. I don't see interest rate of borrowing and interest rate of lending between US and Switzerland. If I have been given the lending and borrowing rate in Switzerland and the USA, then I can think of also using money market. So once that is not given to me, I cannot think of using the money market. So the applicable hedging strategies I can use to hedge that US exposure is simply the forward contract, the futures, and then the options. So we're going to take them 1-1 and start working on that. Okay, so we're going to say A, it's not a report, so I can do it anyhow. My exposure, I have to hedge against. My company is based in Switzerland. Our currency is the CHF, and we have to make dollar payment. Therefore, we will have an exposure. The moment the dollar exchange rate, the dollar CHF exchange rate moves, we might be called upon to pay more or less. And that is what was defined as the transaction exposure when we were doing the lecture. So having got this transaction exposure of US dollars of 50-60,000, okay, and this is what we have to hedge. What hedging strategies can we use? We can think of using one, forward contract. We can think of using forward contract. What will be the forward contract? Because this is supposed to be paid in what? 4 months time. I need to enter into 4 months forward contract. So I will say enter into 4 months forward contract and fix the rate at, I go to the question, where is the forward contract? When we come to the question, forward contract is given here. A forward rate between the US dollar and the CHF of 1.0677. He didn't give the bid, he didn't give the offer, he just gave only one rate. So you simply have to pick that rate and you go ahead. So if this is the rate of 1.0677, then what will be the guaranteed payment? So what will be the guaranteed? The guaranteed payment will simply be the 5060 123 divided by 1.0677. And how much are we going to get in CHF? So that should be the payment. So 5060 123 divided by 1.0677, and that will give me 4739159. 123. So this is all about the forward contract. How many marks do you think here? 1 mark. So you do not have to waste time on it at all. Okay, next is going to be on the currency futures. On the currency futures. Okay, currency futures basically follow some stages and it's one way. So make sure you are with me. Every question is going to repeat. So when I come to currency futures, if you go to the question is saying our currency futures information is given up here. Okay, so they've given me 3-month expiry contract, 6-month expiry contract. The question here is, when you are doing futures, your first requirement will be which of those contracts are you supposed to enter into? Am I supposed to enter into a contract that is 3-month expiry or a contract which is 6-month expiry? Okay, the simple answer for this 1 mark is you have to enter into the contract that will expire immediately after your transaction date. What is your transaction date? Your transaction date is the date you are going to either make the payment or receive the money. According to this question, we are supposed to make dollar payment of 5060 in 4 months time. So which of these two contracts here will mature immediately after the 4 months your transaction date that you have to make the payment? Obviously, it should be the 6 month. The 3-month expiry contract will be too short because you needed up to the 4th month. So you need a contract that will mature immediately after the 4 months your transaction date. So your first stage is what date contract. Okay, we normally write this to help students, but in the exam room don't write that bit. So we say what date contract. What date contract? This bit is what I'm saying. Don't write it. You just go straight and you say you will enter into the 6 months expiry contract. The reason being that it expires immediately after your transaction date, as it expires after 4 months transaction date. Okay, you don't necessarily have to include this bit here. I am teaching. The next level is if you are going to enter into futures contract. Futures give you the obligation to buy or sell standardized amount of a particular currency on a future date at a price. Please be with me. A lot of questions has come through. I've answered them though, but let me also take that advantage to explain here so that you get them straightforward. One of the challenges to most students and futures contract is how to decide whether you enter by buying and close by selling, or enter by selling and close by buying. Okay, the simple answer to that problem is this: futures is giving you the obligation to buy or sell standardized amount of a particular currency on a future date. So if you look at the contract size, what currency is the contract size? The contract size currency is the currency that you can buy or sell under the futures contract. So when we come to this very question, they're telling us that the futures contract is in the size of 125,000 CHF. 125,000 CHF. The meaning is this contract will give you the obligation to buy or sell CHFs in multiples of 125,000. And the common sense here is the currencies involved are dollars and the CHF. You are based in the Switzerland. You have to go and pay dollars. What will you do? I have to sell my CHF in order to go and buy the dollar. And the contract size, my contract size is also in terms of CHF. So you ask yourself, what are you doing to the CHF in this column? Because you are based in Switzerland and you have to pay dollars, you have to give out the Swiss franc, which is the CHF, in order to go and buy the dollars to go and pay. So CHF will be given. So this contract, because the contract size is in CHF, it means you need a contract that will allow you or give you the obligation either to buy or sell CHF. And we've seen that CHF will be sold. Therefore, I need this futures contract that will give me the obligation to sell the CHF, because this is also CHF. So just look at what you're doing to the contract size currency. Here, the contract size currency is the CHF, and as such, you will want the obligation to sell it. So you will tell the examiner, enter the futures contract by selling. By selling, somebody will say you are taking a short position. And when you sell, you will close it by doing the opposite and close by buying. Okay, so that when the CHF depreciate, because that is your worry, you are worried that the CHF will actually fall, so that when you have to convert it, you make a loss, isn't it? Okay, so you will sell it now, so that when the CHF depreciate, you will buy it back cheap. So that is the reason. So enter by selling and close by what? Buying. The next one is, as the definition goes, futures will give you the obligation to buy or sell standardized amount on a future date at a particular price. So the next is what we say your lock-in rate. So here, if you want to follow the stages, buy or sell, and then the next is you calculate your lock-in rate. You calculate your lock-in rate. The lock-in rate is calculated based on formula. Okay, it's simply calculated as the futures price plus or minus the unexpired basis. Unexpired basis. Okay, the unexpired basis is also called the basis at your transaction date. Basis as your transaction date. So we all know the basis. Basis is the difference between the spot rate and the futures price. Okay, let me give you the full formula. To calculate the basis as at the transaction date or unexpired basis, you can calculate it as the spot rate minus the futures price divided by the period from now to maturity of contract, or multiply by period from transaction date to contract maturity. I'm making life very easy for you here. So pick this formula. In the exam room, don't go and write all these. Here I'm teaching That is the reason why I'm bringing your mind on. As long as I know this, when I go to the exam room, I do the date contract, which is the contract that expires immediately after my transaction date. My next level is buy or sell. I've seen that the contract size is in currency called CHF. I asked, will I buy or sell CHF? Because I'm based in Switzerland and I'm going to pay dollars, I have to give out the Swiss franc and then go and buy dollars. So I will sell CHF. So I will enter by selling. Then when I finish, I need my lock-in rate. The whole of this bit is not coming in. I will just come here as my 3 lock-in rate. And that lock-in rate, we said, is the futures. This is what I'm going to picture. Futures price plus or minus unexpired basis. I go to the question, where is the futures price? Futures, I pick 6-month expiry. So the price I need is 1.0659. So I will say 1.0659 plus or minus. Then I need the unexpired basis. The unexpired basis is the spot rate minus the futures price divided by the period from now to maturity of contract multiplied by period from my transaction date to maturity of the contract. So what is the spot rate? I go to the question, where is the spot rate? Question says the current spot rate is 1.0635. So I come here, this is 1.0635 minus the futures price of 1.0659 divided by period from now up to the expiry of the contract. The contract that we pick, they said 6-month expiry. So it means it will expire in 6 months time. I divide by 6, multiply by period from my transaction date up to the maturity date. Maturity date is 6 months from now. My transaction date is 4 months from now. That is when I have to pay. So between 4 months and 6 months, that is what I need to use to multiply. It's going to be 2 months. And I start, what is my lock-in rate? So I will say the 1.0659, then 1.0635 minus 1.0659 divided by 6 times 2, and that is giving minus, because the sum here is minus, so the minus will come up. What you get here, if you got a positive figure here, you are adding to that. If you get a negative figure, you are deducting. So I'm going to have 0.00 So this is 1, 2, 3. There should be 4. So there's another 0, 0, 8. 1, 2, 3, 4. Okay. So how much will it be? That plus 1.0659, and that is simply giving me 1.0651. Okay, so this is the lock-in rate. When you get the lock-in rate, this is the exchange rate of the dollar to the CHF. The futures contract has lock-in. Whatever the exchange rate will be, the effective rate you will exchange the dollar and the CHF will be the 1.0651. So what will be the amount involved? What is the amount? The amount is that you want to pay off 50, 60, 1, 2, 3, and you locked the rate at the 1.0651. So how much CHF are you committed to go and pay? So that I will 50, 60, 1, 2, 3 divide by 1.0651. Okay, divide by 1.0651, and that is given, is it 4750728. Okay, so this is the CHF, and then what will be the number of contracts? Number of contracts, and the number of contract obviously is the amount divided by the contract size. So the amount here is 4750728 divided by the contract size is 125,000. This is CHF. This is also CHF. That is why I can divide. So divide by 125,000, and that is giving me about 38.005 or 6. So I will say about 38 contracts. I will say about 38 contract, and I will say there is more under hedge. Okay, there is more under hedge. The good news is ACCA P4 is not expecting you in current terms to do the under hedge for futures. So this is all about futures, and it is there for 5 marks. So this 5 marks, if you are organized, you will pick it like that. All what you need to remember is pick the date contract. It should be the contract that will mature immediately after your transaction date. Do you enter by buying or selling? Whatever you do to enter, you do the opposite to what? Close it. So here we said you have to look at the currency of the contract size. The contract size is in CHF. Will you buy or will you sell CHF? Because we are based in Switzerland and our currency is CHF. If we have to go and pay dollars, then obviously we have to give out what? The CHF in order to go and buy the dollar. So CHF will be sold, and as such I will enter into the contract by what? Selling the CHF contract, so that when the CHF what depreciate, I'll buy back I'll buy back in order to make a profit. Then come and calculate the lock-in rate. As I told you, don't go and put this formula down. Please learn it. When you go to the exam room, just do this and then go. Just do this and then go. Okay, even this level you can decide to avoid it, because you put this one in the calculator, you take it from that straightforward. It will bring you to that, calculate the amount and calculate the number of contracts, and straightforward you will be able to get the 5 marks easily. Now let's go to the next level. We can also use currency options. We can also use currency options. What will be the currency option? Okay, if we go to the question is telling us here that we've also got currency options. We've got 3-month expiry and 6-month expiry. The same argument as we did for futures. Which of the contracts should we enter into? The hard work had already been done when we did the futures. If futures, you entered into 6-month expiry. When you come to option, you are taking the 6-month expiry as well, because you need a contract that will mature immediately after the transaction date. So normally I advise students, take a bit of a time, judge the futures right. If you judge it, you are rolling it over. So to options. So when I come to the options, I will say my date contract will be to enter into the 6-month expiry. Okay, is it put or call option? Okay, if it is futures, we say buy or sell. In options, the option that will give you the right to buy is called a call option. The option that will give you the right to sell is called a put option. What did we decide in futures? Futures, we said because the contract size is in CHF, we will sell CHF. So we're entering by selling. If you come to options, you also have the right to sell. You don't have the obligation. Therefore, the option that will give you the right to sell is what is called the put option. So take a bit of your time and then judge these two right. When you judge them right, the moment you come to options, you just roll over. So if you sold at what? Futures. If you come to option, you say you are entering into a put option. If you actually bought under futures, when you come to options, you're going to say you are entering into what? A call option. So here, because the contract size is in CHF, we need the contract that will give us the right to deal with that CHF, and the CHF will be sold. Therefore, I will say enter into put option. Put option to have the right to sell CHF. Okay, so that when the CHF depreciate, you sell it and you make a gain in there. Then for options, for you to have the right, that is the only difference here now. For you to have the right, it doesn't come for free. You have to pay a premium. But how many number of contract should you enter into? So go and look at number of contracts. Okay, look at number of contract. How many number of contract? Number of contract is the exposure divided by the contract size. But when you go to options, look at what the examiner normally do. They've given you two prices for the 6-month expiry and 3-month expiry. So he's expecting you to do the two prices all. Okay, so I will say I have got exercise price. My exercise price here are simply 1.06 and then 1.07. Okay, what is my exposure? Nobody needs to write these headings. I'm teaching, that's why I'm showing you. Otherwise, you don't need these headings. My exposure is that I have to go and pay this amount in dollars. Okay, remember these are in dollars. But the contract size I have to divide with is given in terms of what? The CHF. I cannot divide dollar by CHF. It doesn't work like that. I have to bring them to the same base. So what will I do? As long as the contract size is in CHF, I have to bring the value also to the dollar to CHF. Okay. Now, how will I convert this exposure to CHF? Okay. As I told you, these headings you are not showing. We are teaching. That's why we want you to know why we are or how the figures are being got. In the exam room, just flow. Don't be writing the headings. So if I enter into this option, I have fixed the exchange rate at this or that. So if the exchange rate is fixed at $1.06 to 1 CHF and the total amount is 5060, I'm using this 1.06 to convert the 5060 into what? CHF. So I will divide this by that. And when I divide, how much am I going to get? This is 4773. 585. I also divide the 5060 by the 1.07 and that is given 4728972. I have brought them into CHF. So what then is the contract size, which is 125,000 and what will be the number? Okay, what will be the number? So 4773585 divided by 125,000 and that is giving me 38.19 and the other one is giving 37.83. Okay, futures options are supposed to be standardized. You cannot actually enter into a fraction. It should be a whole number. I normally encourage students to always under hedge. It makes the calculation very easy. So here I will say I will enter into 38 and there I will enter into 37 because I want to under hedge. If I under hedge and you over hedge, our figures are going to be slightly different, but it is acceptable because there's no scientific way that, or if it is this, approximate to that, if it is that, approximate to that. No, it doesn't follow any approximation rule. So it's your choice, and I will advise you to use always under hedge. So I will tell the examiner here under hedge and here to under hedge because they are technically more than the 38 and 37. I have got the premium as I told, the number of contract as I told you, because I'm teaching. That is the reason why I'm showing these headings. Picture it at this exercise price, the exposure, I will convert it at that. So straightforward, to get this 38, I could have done 5060 123 divided by 1.06 and when I finish, I will divide everything by 125, 123. That would have brought me to 38.19, and I will say approximately 38. You do the same thing for that line, but because I'm teaching for you to see the movement, that is why I'm showing you what? Those headings. I don't need to show those headings to the examiner. Okay, so when you know the number of contracts you are supposed to enter into, for you to have the option, you would have to pay a premium. How much premium are you supposed to pay? We need to go and calculate that. So I will say next is for you to calculate your premium. It follows stages. How will I calculate the premium? I have to calculate the premium at the exercise price of 1.06 and 1.07. Okay, what will be the premium? The premium will depend on the number of contracts I entered into. At this level, I entered into 38 contracts. Each contract is made up of 125,000 CHF. Okay, here too, I entered into 37, 125,000 CHF. So how much CHFs will come under the contract? Let's multiply. So you will say 38 times 125,000, and that is 475, 1, 2, 3 zeros. Excuse me. And then 37 times 125,000, and that is 462, 5000. These are in CHF. Okay, now let's go to the question and get the premium. So the total amount under the contract, I say I will sell the CHF are these figures. I will sell 475 if I enter into this contract, or 462, 5,000 if I enter into this contract. Now let's go and get the premium from the question. What will be the premium? What will be the premium? The premium here is this. We entered into 6-month expiry, and we said it's a put option. So this is your put option for the 6-month expiry. So this is what you are looking for. Let me do it again. So you entered into put option, and it is 6-month expiry. So this bit is what you're looking for. Any other thing there, you don't need it. Okay, so the meaning here is, read this. Contract size 125,000 CHF. Exercise price quotation, that is fine. US dollar per CHF. Premium, this is what they are telling you about the premium. Premium is cent per CHF. It means for every 1 CHF I will enter in the contract, I will pay premium of these in terms of cent, depending on the exercise price. So when I pick exercise price of 1.06, I am going to pay a premium of 216 cents per every 1 CHF. And the argument we have developed here is that I entered into 38 contracts, and each contract is made up of 125. So the total amount of CHF in the contract is 475,000. And for each CHF, I would have to pay a premium in terms of the cent. And then for this exercise price of 1.06, we're saying the premium is 2.16. A cent. So you, in order to bring it to dollar, don't forget to divide by 100. It's a mistake that people do. So for every 1 CHF, I will pay this cent in what? In terms of premium. So what will be the total premium in dollars? I will have to say 475,123 times 2.16, all divided by 100, and that is giving me 10260. A lot of people confuse what currency you are supposed to put here. The currency you're supposed to put here should be the currency that premium is in. Okay, the premium is in cent, dollars. So we are dividing it by 100 to bring it to dollars, isn't it? So this one should be the dollar. Okay, and then we do the same thing for 1.07 exercise price. The premium that we supposed to pay is given in the question as 2.63. So I will say times 2.63. Don't forget to divide by 100. Common sense is if you can do for one line, you should be able to do for all the other lines. Okay, so we're going to say 4625,123 divided by 100 times 2.63, and that is giving me 121638. Now be with me. Premium is where there's a slight issue here. So 1211638. The premium is in dollars. It's payable in dollars. And you are based in your Switzerland. Your currency is the CHF. If I have to go and pay this premium, what should I do? I have to convert my currency to go and pay this. The premium is supposed to be paid now. So how will I convert my CHF into what? Dollars. Now I need exchange rate. What exchange rate do I need? Because it's now, I need the spot rate. I need the spot rate. I go to the question, where is the spot rate? I go and pick the spot rate. Spot rate was given to me here as 1.0635. I pick it. So 1.0635. 1.0635. And how much will be the premium in my currency, which is the CHF? So that one, if you divide, you're going to get 96474. Here, when you divide, you're getting 114374, and that is the premium. Okay. Yes, there should be another zero. Yes. It's 102,600. Great. Okay, so that is simply the case. And then when we get the premium, the next thing we have to do is, bear with me here. For futures, ACCA P4 is not expecting you to do the over and under hedge. But for options, they include the marking scheme such that you have to do the under or what? Over hedge here. So that's why I wanted you to stick to one thing. If you are under hedging, under hedge throughout. If you are over hedging, over hedge throughout. If you do some over and do some under, it doesn't help, because in the exam room you would have to be switching between over and under, which wastes time. I recommend students to what? Always under. I will show you why. Okay, so when I finish with the premium, my next level is what? To sort out the under hedge. Okay, to sort out the under hedge. Option will push you a bit, because unlike futures that we did for one price, option we're going to do for many prices. Option, but this current examiner is giving only 2 exercise prices, which makes life reasonably comfortable. The common sense is, if you can do for one price, you are just repeating the same principle, just as we're doing here. So under hedge, I go to my number of contracts. That is where I will see the ones that I under hedge or whatever. So when I come here, all of them, I under hedge them. So it means I have to do all of them. So I will do 1.06, 1.07. What am I supposed to hedge? Your under hedge or over hedge is simply the difference between how much you were supposed to hedge and how much you simply hedge. That's it. So how much were we supposed to hedge? We were supposed to hedge 50, 60,000, 6,000, and then here to 50, 60, isn't it? These are in dollars. In the exam room, am I supposed to write that? I wouldn't, but I'm teaching. When I finish, I'll show you the shortcut straight. How much did you hedge? Okay, we were supposed to hedge that, but how much was hedged? You come back here, come back to your premium, you will see the figures. You said you are entering into 38 contracts, and each of the contract is made up of 125,000, and as such you are entering into 475,000 CHF in the contract. So therefore, you have promised the exchange that on that future date, which is 4 months time, you give the exchange this amount of 475,000 and they will convert it at this exchange rate and give you the dollar equivalent. So how much will this amount here exchange at that give you in terms of the dollars? And that is what you would have to compare with that. So straightforward, I will say 475,1234 at a multiply by 1.06. It will give me the dollar equivalent. And when I multiply, it's giving 50.351230. So that is the dollar equivalent I have hedged under the contract. However, the total amount I need to go and pay is the 50.60. So therefore, what I hedge under the option is simply not enough. I have to find the difference. That difference is what we say it is the under hedge. Okay, because you have to hedge 50.60, but you hedge 503. So 50.60 123 minus 503 5123, and that is giving me 25,000 dollars. You do the same thing for the 107. If you can do for one line, obviously you should be able to do for the subsequent ones. So here too, the amount we promised to go and give is this. They will exchange it at that rate. So I will say 4625123 at the 1.07. How much am I going to get in terms of the dollar? And that is 4625123 times 1.07, and this is 4948750. What is the under? I take it from the 50.60, and that is giving me 111,250. If somebody overhead it, you're going to have a different figure slightly in here. Okay, so that is the case. Now it means on that due day, when I go and give this money, this is the dollar I will get. If I go and give this money, this is the dollar I will get. But the person I am owing, I have to go and pay him this amount. Therefore, it is short of 25,000. What will I do? I have to, in addition, convert that 25,000, my money in CHF, into $25,000 to go and pay. That is not now. That is supposed to be converted on a future date. So therefore, to protect myself against the movement in exchange rate, this under hedge or over hedge, I am supposed to hedge it again using forward contract. So don't forget, go and bring your forward rate. Go and bring your forward rate. And that forward rate was given to us. So let's go to the question. According to the question, the forward rate was given us, is it 1.0677? So I will go and multiply. I'll go and make adjustment with 1.0677. 1.0677. I'm converting it into CHF. Therefore, I would have to divide. So I will divide that by 1.0677, and that will give me 104,196. Then 25,000 divided by 1.0677, and that is 23,415. Okay, and then the last one is going to be the outcome, and your 15 or whatever marks is just getting ready. Okay, see, it's only 15 marks, so the examiner is expecting you to be moving. That is why you need to try and cut corners. Everybody knows this figure already. I also see this. I also see that. This figure here and that figure there. I see them here. And this is, I'm converting this at that. So this 25,000, all what I could have done will be the 50.60 minus 475,123 at what? 1.06, all divided by 1.0677. That would have given me the 23,415 straight. Okay, All this is teaching. All this is teaching so that you know where the figures are coming from. The next one, all what I would have done is 50, 60, 1, 2, 3 minus the 4625, 0, 0, 0 at 1.07, all divided by 1.0677. That will bring me to 104196. Full stop. There's no need for me to present it in the tabular form. In the lecture note and the teaching, we are presenting it in that order so that when you are revising, you'll be able to know, oh, this is where the figures are coming from. In the exam room, this is the figures you need. That's it. So why do I have to do them 1, 1, 1, 1? Please flow. You haven't got the time. So when we finish, we need to come and do the net outcome. What will be the overall net outcome here? I have the exercise price of 1.06, 1.07. What is the underlining? What did we promise to go and pay? In terms of CHF, now everything is in terms of CHF. We promised to pay this amount because that is the number of contract we entered into, and each contract is made up of that. That is what you see there. Copy them. Here I will pay 475, 1, 2, 3, 4, 4625, 1, 2, 3. Don't forget that in order to have the option, you need to pay a premium. We calculated the premium up here. So come and pick these two figures and then you move on. So the premiums will be 96, 474, 114, 374. And then come and do the under hedge. The under hedge, when we did, we said 23415, 104196. And then what will be the net payment? Okay. One reason why I want you to under hedge is that if it is under hedge, always you are adding it to this. If you have done over hedge, it means you have received extra money, and that extra money is supposed to come back. So that one will be minusing this. So that is the reason why. So if it is over hedge, you have to minus it from here. If it is under hedge, you are adding whatever the case is. That's why I want you to word under. Okay, and then what will be the net payment, which is 4869889, and this is 4843570. So that is the net payment. Which one are you supposed to actually select? Because it's a payment, you will want to select the hedging strategy. That of course will give you the minimum payment. Okay, so when you look at the options, which one is the minimum here? You discussing, showing to the examiner that the option with an exercise price of 107 will give you a net payment which is less than that of what? The exercise price of 106. So that is the one leading. You compare it with the futures. The futures, what was the amount? The amount under the futures. 1 minute. The amount under the futures is what? 475, which is less than the options. So the futures is automatically better than all the two options. Then go and compare it with the forward contract. The forward contract, the guaranteed amount is 473. So from all these three hedging strategies, the one that will give me the lowest net payment is the one I would have to recommend. So from this, I can recommend that we would have to go in for what? The forward contract. Even though when we go in for the forward contract, it's obligatory, isn't it? And as such, if the exchange rate is better in the market, we still have to what? Use the forward rate. But if we had entered into an option contract and the exchange rate is better in the market than the exercise price we fix in, we can let the option lapse because we haven't got any obligation. So there's that bit of flexibility there. But given this, I will conclude straightforward here that it's better for us to go in for the forward contract because it gives what? The cheapest option, isn't it? So go in for the forward contract. Don't just look at it and say, oh, go in for the forward contract. The examiner will expect you to be doing comparison that, oh, this is cheaper, this is cheaper, this is cheaper, then overall this is cheaper. So I recommend that this is what they would have to go in for. Okay, so that is the case. So this is basically your requirement A. Okay, so advise CMC Co on appropriate hedging strategy. So your advice eventually is that go in for forward contract, because that forward contract obviously is the cheapest. Now let's go to B. Demonstrate how CMC Co could benefit from the swap offered by Pecunia Bank. Okay, what is swap? This is an interest rate swap. Interest rate swap is I have got a fixed rate and I'm worried that interest rate will actually fall in the future. So I want to move from my fixed to what? Variable. So that when the interest rate decrease in the future, I will be able to make some savings. You are also having a variable rate, and your worry is interest rate will be what? Increasing in the future. So if the interest rate increase in the future, then obviously you will be called upon to pay more. So you also want to move away from your variable to your fixed. One way we can do this is I will go to my bank and tell my bank I want to move my loan from fixed to variable. You know what the bank manager might be telling me? Oh, Fred, if you convert, then it means we have to redeem the first one and bring you from the fixed to the variable. They might charge you early redemption penalty and all the complications that might go with it. If you also go there, you might face the same problems, isn't it? So therefore, the two of us can come together and then we exchange our interest rate commitment. You will give me your variable and I will give you my fixed. However, the banks that we borrowed from, they don't have any clue as to whether we have swapped or not. If I borrowed my fixed, I have to go and pay my bank the fixed, which is the actual interest. You also have to go and pay your bank the variable. Then when we have sorted out our banks, then the two of us will come together for the swap arrangement, isn't it? Because that swap arrangement has got nothing to do with our respective banks. However, how will I know my swap partner? How will I know my swap partner? I wouldn't be able to put it on a placard going around here and there. I'm looking for a swap partner. No, I can go and give my specification to a bank, so that if somebody like you also want the reversal of what I have, then you also give your specification to the bank and the bank will bring the two of us together. Okay, and normally the bank serving as just an intermediary, bringing the two of us, obviously will demand what? A fee. It's not going to be free. So we need to watch out. And let's go to the question. This 6 marks. You can get it within 2 minutes if you know what you are doing. Okay, so let's come here. If you come to where the swap arrangement was given, this is where the swap arrangement, according to Pecunia Bank, they said an interest rate swap contract with a counterparty. Okay, with a counterparty where the counterparty can borrow at an annual floating rate based on the yield curve plus 0.8 or an annual fixed rate of 3.8%. Pecunia Bank will charge a fee of 20 basis points, which is 0.2%, each to act as the intermediary of the swap. Both parties will benefit equally from the swap contract. Okay, so now if there's a counterparty, the counterparty will borrow at a flexible or floating rate of that. If they go to the bank directly for a fix, they will have to pay what? 3.8. Okay, what about us? If you come up here, that is where they illustrated that this is the loan we have gone in for. And that 60 million, they're saying that interest will be payable on the loan at a fixed annual rate of 2.2%. So we will pay 2.2. If we want to move from the fixed to the floating rate, then it will be the yield plus 0.40. So what will we do? We'll just swap it. The moment the two of us will come together to undertake something like this nature. As we know, 2 heads, they say, is better than 1. So the moment 2 of us come together, we are complementing each other, and we will save what? Interest. That amount of interest is what they refer to as the arbitrage gain. That arbitrage gain is what we are going to enjoy as a result of the swap, and that is what the question is asking for. And when they ask you to calculate the arbitrage gain, please, it's for you. It's very, very, very straightforward. So now, that arbitrage gain, or somebody will say the synergistic gain, because when we come together, synergy is coming up. We are complementing each other in order for the 2 of us to save what? Interest. Okay, so that gain is what the examiner is asking you to demonstrate how much gain or the benefit that CMC can get as a result of coming out with that swap arrangement. So the synergy or the arbitrage gain or that benefit as a result of the swap is simply calculated as the difference between the fixed rate and the difference between the variable rate. Simple. Okay, so now this is how you're going to calculate that. So I will say that we have the fixed rate and we have the floating rate, which is the variable rate. Okay, what do we have? This is our company CMC, and then there is a counterparty. That counterparty, let me do a CP. Okay, what is the fixed rate for CMC? CMC, when you go to the question, CMC fixed rate is 2.4. Variable rate is the yield plus 0.4. So I will say this is 2.2, all percentages anyway. And then this is yield plus 0.4%. Okay. And then next, what about the counterparty? The counterparty is what the examiner gave to us down here, that the counterparty can borrow fixed at 3.8 and variable at yield plus what? 0.8. So I will say this is 3.8% and this is yield plus 0.8%. Okay, what is the difference here? This is minus 1.6%. What is the difference here? This minus that, the yield will cancel. So this will also give me minus 0.4%. Okay, the arbitrage gain is the difference between this and that. So my arbitrage gain is calculated as minus 1.6 minus 0.4, and that will give me minus 1.2. Now be with me. The final answer that you will get here, being it minus or being it positive, it is the gain. So bring that 1.2 as the gain. The answer is, if I have brought this one first, this would have been positive. If I brought this one like this and that one like that, this would have been positive. This would have been what? Positive. And then 1.6 minus what? 0.4 will give you 1.2. So you do the mathematics here. Whatever you get finally, being it negative or being it positive, you do not have to bother yourself with the negative. It is a gain. So my arbitrage gain is simply 1.2. Then you ask the question, if the arbitrage gain is 1.2, is the benefit that all of us together are going to enjoy? You enjoy bit, I will enjoy bit. Therefore, how much will I enjoy and how much will you enjoy? The question is supposed to tell us. So how much of this will go to CMC and how much of that will go to our counterparty? Okay, so let's go and ask the question. Question is telling us something that both parties will benefit equally from the swap. So if both parties will benefit equally from the swap, then here we'll get 0.6. This will also get 0.6. We don't get everything because the bank manager who brought us together is charging a fee for serving as an intermediary, and they said Pecunia Bank will charge a fee of 20 basis points each to act as the intermediary. So when we enjoy the 0.6, we would have to pay a fee out of it, which is 0.2. So technically, we will benefit 0.4%. We will benefit 0.4%. This is what technically the examiner wanted. So CMC, by entering into this swap contract, every year I will save interest of 0.4. How much are we going to borrow? According to the question, we're going to borrow 60 million. If you can remember, we're going to borrow 60 million. If we are borrowing 60 million, then obviously, how much are we going to save? If every year I'm going to save 0.4, then the interest saved totally, interest saved per year will be 0.4% of the 60 million. And how much is that? So 0.4 divided by 100 times 60, 123, and that is going to be 240 CHF every year. Okay, this is what the examiner wanted. Actually, he wanted up to this point for the 6 marks. So doing this for 6 marks, if I'm sitting down in the exam room, getting the 1.2, sharing it to get the 0.4 for 6 marks, how many marks will this option will be given to me? I will pick that 6 marks first before I will even come and think about the A, because the B doesn't depend on that. Once I've picked this easy 6 marks, I know that, yeah, I'm doing something. My body and my brain is happy. It will edge me the more. But when I start with the A and it's punishing me, looking at the time, I'm not coming out. There are a lot to do. It put pressure on me. When I come to the B, which is easy, I can't even do it, because at that time, I am under serious pressure. That's why I keep telling you, analyze the requirement, which one you should do earlier. Okay, so watch out for that. This is what your 6 marks wanted, but I'm taking advantage of it to push you to the next level. I'm taking advantage of it. The same swap agreement will come. They will give our fixed and variable rate, and then that of the counterparty, fixed and variable rate. And the examiner will ask you to calculate the effect on the market value of the CMC as a result of the swap arrangement. That's one question. This same question will come. Instead of demonstrate the benefit, he's going to tell you, calculate the effect on the market value of the company as a result of entering into the swap agreement. I'm going a step outside the lecture, the question. Okay, so what will be the effect on the market value of a company? We all said the market value of a company is the present value of the future cash flows. Therefore, if every year as a result of this swap, I will save 0.4%, and as such, I will save interest of 240,000. It follows something like subsidized loan. When you save interest, what happens? Your value should increase by the present value of that tax, the savings in the interest. So I will save 240,000 every year. So if I save 240,000 every year, the term of the loan is 5 years. So for the 5 years, every year I am saving 240. So my market value should increase by the present value of that 240, holding tax constant. So if there is tax, then the changes in market value will be the 240,000 multiplied by 1 minus the tax rate, or multiplied by the annuity factor of 5 years. Given this question, 5 years, whatever discount factor or cost of capital the examiner will give to you. So if you want the effect on the market value, the effect is that, is the market value going to increase or decrease as a result of the swap? And we've seen that yes, it will change as a result of the swap, because we will save 240. Knock off the tax and multiply by an annuity factor of whatever discount factor is given to you, and then project it into the 5-year period, and that is the changes. the next question the examiner can further ask out of this is that he's going to give you, okay, the information about CMC, fixed rate, variable rate, just like this, fixed rate, variable rate of the counterparty. And then the examiner will ask you to prepare a swap agreement that will be beneficial to both parties. Prepare a swap or come out with or determine a swap arrangement. So let me also do that one for you in case he does that. Swap arrangement. If you want a swap arrangement, how will you do it? Please picture this. Please picture that. Just as we did in forward rate agreement, it follows the same thing. If you remember, I said that if we come together to swap, it is between the two of us, even though a bank was an intermediary. The bank I borrowed from has got nothing to do with you. My fixed interest is my job to go and pay. Your variable is your job to go and pay. When we finish, then the two of us will come together to think about the swap arrangement. So the first thing here is that this is CMC and this is the counterparty. What I'm doing is not part of the question. It's another follow-up, a question that the examiner can ask. Okay, so what will I do? If you want me to determine the swap arrangement that will be beneficial, I will first have to calculate my arbitrage gain to come and get these figures here. Share it 0.4 and 0.4. Brilliant. So I'll start here by saying that CMC, what will be my actual rate? So what is the actual rate? This is what I would have to pay to my bank. This is what the counterparty should pay to the bank based on what they initially agreed with the banks that they borrowed from. So this is the actual interest. We are saying CMC is on fixed, so he's paying 2.2%, and then CP, which is the counterparty, is on variable, and they said it's yield plus the 0.8%. That is what they would have to pay. Everybody will pay to their respective bank. When we finish, then we have to come together to think about the swap arrangement. This is what the examiner is expecting you to calculate or show. So what will be the swap arrangement? ICMC, I am supposed to give something to CP, and CP is also supposed to give something to me, and then that is the swap, isn't it? Because we have swapped, I have to get his, and then he has to come and get mine. So I have to give him something and I take something from him. He has to give me something and I take something from him. That is the swap. Okay, so say CMC to the counterparty. You don't know it yet. Then counterparty to CMC. You don't know it yet. This is the full template. So because you're going to work backwards. So when we sum up this will be the net interest. And or somebody will say with swaps. Okay. If we didn't swap, what would the situation be? So what is the net interest without swap? The common sense here is that if I swap, I will get benefit, and the benefit I will get is what is going to be the difference between what I am paying with the swap and what I would have paid without the swap. And that benefit is what we call the synergistic or the arbitrage gain. So this is the arbitrage gain. Please picture it. And we said the arbitrage gain, everybody is getting 0.6, and then you less the fees, and we said 0.2, and this brings us the net worth benefit under the swap, which is the 0.4. That's it. What the examiner wants you to do is to come out with how much CMC will pay to CP and how much CP will also pay to CMC. Here is what they want us to develop. And to develop it, we need to start from down here and take ourselves up. That's why I'm telling you to picture this. Okay, CMC is on fixed. Its intention is to move to variable. Therefore, if CMC should go variable, CMC would have paid the yield plus 0.4. Let me bring you on that level. CMC, if they move into variable, they will have paid the yield plus 0.4%. So if they are not swapping and they went to the bank directly for the variable, what they would have paid would be the yield plus 0.4. So this is the case. So I will say here that without the swap, UCMC, you would have paid the yield plus 0.4. What about the counterparty? Counterparty, you are on variable. If you wanted to go to fixed without the swap, how much fixed will you pay? If we go to the question told us you're going to pay an amount of what? 3.8% fixed. So that is your fix. Come and put the 3.8% here. And now be with me. We're working backwards. That is what makes this one a bit tricky. So picture the template and then watch it, do your calculations upwards. Okay, now the gain we made as a result of the swap is this. So if without the swap, CP would have paid 3.8, and with the swap, you would have made a gain of 0.6. Then with the swap, how much did you pay? It means I paid something under the swap, which is less than without the swap. That gave me a benefit of 0.8. And aside, this is going to be 3.2, isn't it? So I will pay 3.2 under the swap, so that if I didn't swap, I would have paid 3.8. So the swap had saved me 0.6 overall. What about CMC? Without the swap, I would have paid yield plus 0.4. But with the swap, what I paid is less than what I would have paid if I didn't swap by the 0.6, which is the benefit. So this, just as we did here, this minus that gave us this. So this minus that should also give us that. Yield plus 0.4 minus 0.6 will give me yield minus 0.2%, because this is minus 0.6 here, and that will give me minus 0.2%. So this is the case. So with the swap, this is what we're paying. So now we're going to do mathematics to come out with arrangement. Whatever CMC will pay to CP and whatever they will receive from CP, when you add these three figures, it should be equal to that. When you add these three figures, it should be equal to that. So now let's see how we will do that calculations. Okay, it's reversal. So the common sense is I normally ask students to start with the person which is having no yield with respect to the net interest with swap. Okay, so I have got 3.2%. This is the amount I will pay under the swap, but here I see yield. So if I see yield, this is payment, isn't it? These are payments, remember? Okay, so if I see yield to be paid, then for me to pay 3.2 without the yield, it means I have to receive yield from the other party, which common sense will also tell you CMC is moving away from fixed to variable. So he has to pay what? Yield. So when he is paying yield, CP will receive. So I'll say CMC to CP. CP will receive the yield, and then CMC will pay the yield. Okay, so this yield will cancel this because this is payment and this is receipt. So whatever is here plus this plus that should give me this. So if this is payment If this one will cancel that, then I've got 0.8% payment, but the overall payment should be equal to 3.2%. So 3.2 minus 0.8 will give me 2.4%. I have to pay that. So when I receive this yield, this one cancels that. I pay this and I pay that. The total payment will be equal to 3.2. That is the reversal. This is the worst case scenario of swap. That's why I want to take the advantage of this to illustrate. Okay. Next, if CP pay this, then it means CMC should receive what? 2.4%. When you sum up these figures, it should be equal to that. And then you'll be able to test yourself to check whether you've done it right. So 2.2 plus the yield will give you yield plus that 2.2 minus 2.4. So this is what I'm doing. I've got 2.2 payment. I've also got yield payment. And I've also received what? 2.4. What will be the answer? I will get the yield plus 2.2 minus 2.4. 2.2 minus 2.4 will give me the yield minus what? 0.2. And that is what we have shown here. And that is what we have shown here. And the swap arrangement that you're going to suggest to the examiner is that when the two party comes together, CMC should pay the yield to the CP, and then CP will pay CMC 2.4, and that is the swap arrangement that will be beneficial for the two parties to enjoy the benefit word equally. So that is the how far the examiner can go, and this is the swap questions. So either you are just calculating the arbitrage gain, or examiner want you to link it with the value of the company, or he can tell you calculate the present value of the cash flows as a result of the swap, or he can tell you to develop the swap arrangement. That is all about swap. And I see that the worst of the case is when you are asked to come out with what? The swap arrangement. So picture, start from the bottom and move yourself up. You'll be able to come out with a swap arrangement as the differences in the movement. Full stop. So let's go to the C quickly. Let's go to the C quickly. Okay. So that's 6 marks, please. That one was a straightforward. You just calculating the arbitrage gain, the benefit that we will get as a result of the swap. It's just about 2 minutes sort of work. So that is, to me, the first one that is supposed to have been answered. But most students will not even go there anyway, because once they've seen forward contract, they've seen forward contract, they've seen futures, they've seen options. Oh, we know them. They go and stay there. They never come out. And by the time that they realize that they are behind time, it's over. Okay, so watch out. You need to be strategic. C, as an alternative to paying the principal on the loan as one lump sum at the end of the 4th year, CMC Co. could pay off the loan in equal annual amount over the 4 years, similar to an annuity. In this case, an annual interest rate of 2% will be payable, which is the same as the loan's gross redemption yield to maturity. Calculate the modified duration of the loan if it is repaid in equal amount, and explain how duration can be used to measure the sensitivity of the loan to changes in interest rate. Okay, what is duration? If you remember from chapter number 2, we made mention that duration is the weighted average number of years the cash flows from an investment will be able to recover the investment, the weighted average number of years the present value of the cash flows from an investment will be able to recover the investment. And that is also the same as if that investment is in relation to bonds or debt. Okay, and that one related to debt, we technically call it the Frederick Macaulay duration. So whatever it is, the calculation is the same. So when you are talking about weighted average, when I was teaching, I told you weighted average is simply equals to the arithmetic mean. And I told you arithmetic mean should be calculated as, so mean which is the same as the way you calculate your duration, should be calculated as sigma fs divided by sigma what? F. And we said the F is the present value of the future cash flows, and then the S is the number of years. Is the number of years. That's it. So to discount the cash flows as we want the PV, if we are doing Frederick Macaulay, the discount factor should be the internal rate of return. Okay, so now let's go to the question. I need the cash flows in order to get the present value of the cash flows. I will need the internal rate of return of the cash flows. So if the internal rate of return is not given to me, it's my job to calculate it. And then if it's given, you pick it. And then you will calculate the duration. So when we go to this question is very clear. Question is saying that we are supposed to borrow, if you remember, we are supposed to borrow 60 million and we were supposed to have paid interest. Come here. Okay. Here, when you come here, it said the loan principal amount will be repayable in full at the end of the 4th year. It means interest will be paid every year and then the loan amount will be paid in full at the end of the 4th year. That is the original arrangement. But when you come to the requirement, this is where a lot of students couldn't link. Okay, when you come to the requirement, they said as an alternative to paying the principal on the loan as one lump sum at the end of the 4th year, CMC Co. could pay off the loan in equal annual amount over the 4 years. And the requirement was calculate the duration if the loan is repaid in equal annual amount. Okay, so when you go in for a loan, either you are just a plain vanilla whereby you pay interest, and the end of the period you pay interest and the principal, or you pay equal installment and come the end of the last installment, both interest and the principal all are cancelled out. Okay, so here they don't want interest and the principal. They wanted the annual installment. So my cash flow should be the annual payment I'm going to make over the 4-year period the loan is supposed to go. How do I calculate the annual payment? It's the same as equivalent annual cost. What is the equivalent annual cost? So my annual payment, he even help you to say like annuity. My annual payment will be the present value divided by the annuity factor over the period. If you remember this primary school. So the 60 million I borrowed, is the present value divided by the annuity factor in terms of the internal rate of return. What is the internal rate of return given? If you come to the question said, in this case, an annual interest rate of 2% will be payable, isn't it? Which is the same as the loan gross redemption yield. Alternative name for internal rate of return is the gross redemption yield or yield to maturity. So he's giving me 2%. So if it is 2%, I will need the annuity factor of 2%. How many years? 2% 4 years over the life of the project. And the annuity factor of 2% 4 years is 3.808. Okay, 3.808. So we go straight here and I will say 3 points. So I will say annuity factor of 2% 4 years, which is 3.808. And how much am I going to get? So 60, 123 divided by 3.808, and that is given 157,56303. So every year, this is the amount I would have to be paying. So what will be the cash flows over the 4-year period? Every year, I'm paying this amount. So I can now calculate my duration. Oh, sorry, 1 minute. I can now calculate my duration, and that duration will be, I need the present value of the cash flows. The cash flows I have got. To get the present value, I need to discount the cash flows with the internal rate of return, and then the duration follows. So I will say years. I will have year 1, year 2, year 3, and year 4. What are the cash flows? 1,5,7,5,6,3,0,3. Every year, this is what I would have to pay. And some goes towards interest, some goes towards the principal. This is what I have to pay as my cash flows. What then will be the discount factor? Discount factor will be the internal rate of return of 2%. So 2%, if you go to the table, 2% year 1 is 0.980, 0.961, 0.942, 0.924. And then what will be the present value? We multiply this by that, and that should give us 1,544,1177. The next one is 1,514,1807. Next is 1,484,2437, and then 1,455,8824. As long as you have discounted these cash flows with internal rate of return, the total of the PV should be equal to your initial investment. When you sum them up, it should bring you to the present value of the investment, which is the 60,000 or 60 million. Now, I need duration, and duration we said is the sigma fs. This is the PV, this is the number of years. So if I have got the PV, this is my F, and number of years is the X. So what is my Fx? I would have to multiply this by that, multiply this by that, multiply this by that, multiply this by that. So 1 times that will give you 1,544,1177. This times 2, so this times that will give us 30283614, and then this times 3, that will give us 44527311, and then this times 4, which will give us 58235296. So sum them up. We need the sigma fs. This is the formula I'm looking for. So sigma fs, when you sum up all this, it gives 148487398. Okay, so having got these, I have to say sigma fs divided by sigma f. This is the sigma fs, and this is the sigma f. Therefore, my duration will be equals to the 148,487,398 divided by the 60 million. And how much is that? That is giving a figure of 2.47 years. Okay, I am teaching, that's why I still have to show you this. The common sense is that you want the sum of this. So why will I do this? This times that, put it there. 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 When I finish, I come and multiply this times that. Can't I do 1 times this times that? That will give me this straight. As long as I've used internal rate of return here, this 60 million, I knew it already. So there's no need for me to waste time to write all these. It's just waste of time. 1 times this times that, give me this. 2 times this times that, give me that. 3 times this times that, straight. 4 times this times that, straight. Sum up all that. The 60 million is there as the loan that you took. Just divide by that. You come and get this 2.47. Okay, so balance time. This is teaching. This is teaching. In the exam room, you are not teaching. You just have to flow. Okay, the question didn't ask for duration. Question asked for modified duration. Okay, I'm taking you to the next level. Modified duration. Modified duration is calculated as the duration divided by 1 plus the R. R is the cost of the capital you use. Our duration is 2.47 divided by the cost of capital of 2%. So that is going to be 1.02. And how much is that? So I have 2.47 divided by 1.02, and that is 2.42 thereabout. All are in years. Okay, what does duration measure? Okay, or what does the modified duration measure? That is what the examiner is asking you in the next question there. The question is telling you, and explain how duration can be used to measure the sensitivity of the loan to changes in interest rate. Okay, to changes in interest rate. What should you say there? If you have got a bond and the bond is having a very short duration, what is the meaning? The meaning is that you will recover your money quickly from that particular investment in the bond. So when you recover your money quickly, you are not going to be very much concerned about future interest rate, because you have already got your money. But when the duration is very long, then you should be worried about movement in interest rate. The moment interest rate changes, then the market value of your bond should also change. So the simple conclusion here is this: when a bond or debt is having a very short duration, the market value of that particular debt is less sensitive to changes in what? Interest rate. And when the bond is having a very long duration, then that bond value is very sensitive. You have to be concerned, you'll be sensitive about the movement in interest rate when you have to recover your money on a very long term, isn't it? So when they ask you to look at the sensitivity, the value of a bond has got something to do with the interest rate. Therefore, is the interest rate going to, or changes in interest rate, how much the changes in interest rate will affect the value of the bond, is what is measured by the duration, the sensitivity of it. So now let's write something about it. So we're going to say that the shorter the duration, the less sensitive the value of the debt is to changes in interest rate, of course, and vice versa. So if your duration is short, then the interest rate changes is going to have a less effect. The relationship between change in debt value and change in interest rate is given as, okay, the change in the value, which is the change in price of the debt, is equals to minus D, which is the modified duration, multiplied by change in interest rate, multiplied by the original price. P is the original price of the bond, and then minus D, or D is the modified duration. So we use the modified duration to measure the sensitivity of the market value relative to the interest rate changes. And then change in I is simply change in interest rate. and then change in P obviously is change in price or value of bond. Okay, so as you can see, the more duration, because this is a minus figure, the higher the modified duration, the more this figure here is going to be minus, and the more the change in the price of the item will be sensitive to changes in interest rate. So that is basically that. It technically assumes what? A linear relationship, but technically it's not a linear relationship. So we can use this just if the interest rate is basically what? Changes in small order. So this is basically your duration. This is basically your modified duration. The longer the duration, the more sensitive the value of the bond is to changes in interest rate. You should be worried about it because the money will take a long time to be recovered. If you can get your money quickly, obviously you are not so much concerned about changes in what? Interest rate, because you've got your money and then you are just enjoying with it. Okay, so now let's go to the other bit of the question. Let's go to the other bit of the question. Okay, so that is that. Look at the one question. It's picking us from so many angles. Look at where the forward contract, futures, and options are in the lecture note. Look at where the swaps are, and then look at where the duration was, chapter number 2, and then the A and the B were in chapter number 19, 16, and 17, and all that. Okay, so that is why those days I was telling you, you would have to make sure that you are actually learning the topics together, because they come together as a package. Okay, next, prepare a memorandum for the board of directors of CMC Co., which I discusses proposal 1 in light of the concerns raised by the non-executive directors, and discuss the agency issues related to proposal 2 and how these can be mitigated. 9 marks. Okay, it's a report for the professional marks. Now we know how to deal with that. So first, discuss proposal 1 in light of the concerns raised by the non-executive directors. So I have to go to the question to go and look for what are the concerns raised by the non-executive directors. So when we come here, okay, this is where the response is from. Examiner did well by giving headings. That's why you didn't see me writing so many things. So we go straight. When the proposals were put to the non-executive directors, they indicated that they were broadly supportive of the second proposal if the financial benefit outweighs the cost of setting up and running the 4 branches. However, they felt that they could not support the first proposal, as this will reduce shareholder value because the costs related to undertaking the proposal are likely to outweigh the benefit. And the question wants us to address the concern of them in relation to proposal 1. Proposal 1, what is it? Proposal 1 was to hedge foreign currency and interest rate exposure. So the question is just telling you indirectly that the non-executive directors are saying they are not going to support the first proposal, which is to hedge against interest rate and currency movement, because their concern is that it will reduce shareholders' value because the costs related to undertaking that proposal are likely to outweigh the benefit. Do you agree with them? Okay, do you agree with them? Most students couldn't link, which I don't blame them, because you have to be top of your game. The whole question here, it was bits and pieces from other questions. They brought them together. Okay, in another question they've asked, is it good for you to hedge or not? So indirectly they are asking us, is it good for us to hedge? When you hedge, will you be able to increase the value of your company? Or according to the non-executives directors, they are saying they believe it will rather reduce the shareholders' wealth because the cost will be more than the benefit. Do you agree with them? Okay, we know how to write a report, so let me go straight with the argument. Okay, so their argument here is that there is no need for the company to hedge, because when they hedge, it will reduce shareholders' wealth. Do we agree? It's an argument. So according to them, hedging will reduce shareholders' wealth. Therefore, no need for it. According to them, do you agree? Okay, I will agree and disagree. Hedging is there to reduce risk. This is where students couldn't analyze. Hedging is there to reduce risk. So if hedging will be able to reduce risk, then it will reduce WACC and the market value of the company will increase. Or even the cash flows of the company will increase. But if the hedging cannot reduce risk, then there's no benefit. And when we are talking about risk that we can reduce, we can either reduce unsystematic risk. It is only unsystematic risk that can be reduced. Systematic risk cannot be reduced. If you remember, systematic risk cannot be reduced. Only unsystematic risk can be reduced. And when we live in a perfect market, as Capim assumed, when we live in a perfect market, the unsystematic risk is fully eliminated and we have only systematic risk. And therefore, if we hedge in perfect market and the unsystematic risk is fully eliminated and the systematic risk cannot be reduced, then the hedging, what are we doing it to reduce? That cannot be used to reduce the systematic risk, and therefore the hedging will be useless. The cost will be greater than the benefit, and shareholders' wealth automatically will be reduced. So that is what they were arguing. So they were arguing, in a sense, in a perfect market. So if I have to continue, they were arguing with respect to perfect market. In perfect market, where information is free and equally available to all unsystematic risk is eliminated through diversification, and hedging cannot be used to reduce risk, as systematic risk cannot be reduced. So that is the argument you would have to raise here. Okay, that is the argument you would have to raise there. Okay, so if we are in a perfect market, then the cost of that hedging will outweigh the benefit, and the market value of the company will actually reduce. Hence, the cost of the hedging will outweigh the benefit. Market value of company will fall. However, do we live in a perfect market? We don't live in a perfect market. We live in an imperfect market. However, in imperfect market, it is not possible to fully eliminate unsystematic risk. Hence, hedging will further reduce unsystematic risk, leading to increase in market value. For example, hedging can increase cash flows by reducing volatility. Okay, and because cash flow increase, market value will also increase, because it's the present value of the future cash flows. Example is what are linked when we're doing the swap. I told you that the market value might increase by the PV of this. This is the market value. So as a result of hedging, you can use this even to support your calculation, your discussion. As a result of hedging using the swap, every year we will save 240 before tax, and as such our market value will increase by the present value of the net of the 240, because our cash flows will increase. Okay, so as a result of reducing or eliminating the uncertainty or the volatility, we will be able to increase cash flows. Hence, we will increase market value. Hedging. Question here is, hedging is to reduce risk. Will you like to work for a company that is not taking any measures to manage risk? That can happen. They are living in a perfect market. We don't live in a perfect market. So hedging, let me do it point here for you, can reduce agency issues from employees and maybe directors. Okay, employees and directors have, especially employees, we haven't got a diversified employment, because when you are working for a company, you are supposed to work for that company. You can't work for another company because of conflict of interest. So what should happen if, because of conflict of interest, you can't work for another company, and I'm working for only LSBF and no risk measure is taken, will I have to stay here? Obviously no, because what if tomorrow is not there? How can I live my life? So I have to make sure that they are putting into play risk measures, so that they will be able to actually come out with solutions when risk is actually up, and then they will be able to reduce that. Otherwise, what's the point? Shareholders, unlike employees and directors, they can buy shares in company A, buy shares in company B, C, 3, 4 companies, 5 companies. They can manage their own diversification. Sometimes they don't even need the company to do it for them, because you can spread your investment. But if I'm working for one company, how do I spread my investment? So if there's no hedging strategy to manage risk, you can't see me there. Okay, so it will reduce agency costs. Next, hedging can also even reduce conflict of interest for the debt holders, because if you are going to give a company debt, you should be worried about risk. So if the company is not coming out with any risk measure, obviously you are going to give them restrictive covenant. But if they are taking steps to manage risk as a result of the hedging, the restrictive covenant will be less, isn't it? So hedging can help reduce restrictive covenants attached to debt. It can help reduce restrictive covenant attached to debt. So definitely we still have to think of hedging, but it's not a clear cut, because sometimes some people will hedge and then there's no need for them to hedge, even though we live in a imperfect market. If you remember, when we were talking about factors to consider before you hedge, we said look at the costs involved. And sometimes hedging is not removing everything. Hedging is just giving you that uncertainty, removing that uncertainty for you, because sometimes it would have been better you didn't hedge and the benefit will outweigh. So it's not a clear cut. You have to get expert to do the analysis for you to be able to see that you hedge. For instance, if I have to receive money in dollars and I enter into a forward contract and I fix it, okay, this example that we did, let me even use it to illustrate the forward contract. We said we are fixing the rate. Where are you, forward contract? We're fixing the rate at this. What if on that day we were exchanging, this one was, let's say 2. If it was 2, it means in the market I would have got 2530000 payment. Okay, but because I entered into the forward contract, I am obliged to go and pay this. But the market rate is 2. I should have paid that, but because I've entered into the contract, I will have to honor it. And this is the gap. I'm still making a loss. The hedging hasn't been good for me. Okay, so review the answer there. These are the points that you need to actually discuss about. Okay, you need to talk about them. Then the next question here is going to be with the II or so, and it's saying discuss the agency issues related to proposal 2 and how this can be mitigated. Okay, we indicated the agency issue here, and they said that the branches will be controlled and staffed by the local population in those countries. However, some members of the board expressed concern that such a move will create agency issues between CMC Co., central management, and the management controlling the branches. What are the agency issues? It's like F9 agency theory. There is going to be what? Conflict of interest. So the agency problem, which is also called the agency issue, is simply conflict of interest. So there will be conflict of interest between the managers at the head office and the managers for each branch. Why? Because all of them might have different objectives, and then all of them too might have different level of information. And as you learn from your F9, the causes of conflict of interest are 1, differences in objectives, and then 2, information asymmetry. One of them might have more information than the other, and taking decisions, I will say I want to do this based on the information I have. You also say no, we have to do the other one because of the sort of information that we have. We will come on the same page if all of us are having the same sort of information. So what are the agency issues? So straightforward, your agency issues here will be simply the conflict of interest between the management at head office and the branches. Okay, this will be caused by 1, differences in objectives, which will lead to their motivation. What are you motivated to achieve? The branch manager will be motivated to make sure that his branch is doing very, very well. Even if other branches are not doing well, he wouldn't care, because being a selfish human being, my objective and motivation will be that if my division is able to do well, everybody will say, oh, Fred is the man, Fred is the one doing it, and I'm happy. even if the whole company is not doing well. This is the human nature, isn't it? So there will be differences in what objectives. The head office managers will want a situation where all the companies are doing well, because maybe their bonus is based on every branch doing well, because they are there more or less to supervise all of the branches. The branch A manager will be responsible for his branch, and he will come out with what, as they say, sub-optimization. He will want to sub-optimize his division in order to get the praise and get the reward associated with it. Even if the other branches are not doing well, do I care? I don't care, because I want my reward and I want the praise, isn't it? Another one, so you explain that. Another one is that there is information asymmetry. Information asymmetry is just simply differences in information available. For all things being equal, the head office managers will have more information than the branch manager. Me being in branch A, I'm not worried about what is going on in branch B. So when I'm taking a decision, I will take decision based on what I think is relevant here. Meanwhile, my actions in that department or that division might have impact on the other divisions. Do I care? I don't care. But the head office will want that, oh, they've seen what is in my division, they've seen what is in other divisions, and aside they want that harmonization, and they will come out with information that, oh, Fred, let's do this, let's do that. I will say, no, we are not doing that, because I don't care. I haven't got that information. And when this departmentalization or decentralization come up, some of these things definitely will come up, so watch out for it. How can we resolve them? What will be how do we resolve them? Mitigation. Okay, so to resolve them, first we need to set what? Target. Okay, even let me say this, because this is international one. So sometimes even conflict of interest from international point of view will come because of what? Differences in culture. Differences in culture. Because of the culture differences, people have got different perceptions about the way things are being done. And as a result, whatever your perspective is, I don't want to say it because I have a different opinion about it because of my background and diversity. Definitely, I'm going to have a different opinion. So that can also bring conflict of what? Interest. To resolve it, we need to set target for each branch. And we have to ensure that all are agreed. Every manager agreed to it. You would have to obviously monitor the target. And when you monitor the target to ensure are they actually moving according to the target, otherwise it will not bring to the level of the corporate objective. Then monitor, and then when you are monitoring, you need to reward. The rewarding system is where you have to be very careful. The rewarding system, if you reward it based on achieving only branch objective, you're going to be in trouble. That sub-optimization will still be there. So the reward system should be linked to overall company performance. Okay, don't add it to, just link it to performance of a branch, overall company's performance. And then you can also make sure that there is effective communication. There is effective communication between them so that everybody will know the impact of what they are doing on the other company. Okay, so this is basically that question. Let's take about 30 minutes or so for the next question. Let's take 30 minutes or so for the next question. So if we go to our planner, we've got R1 code December 2013. So you look at that question that we did. 50 marker question. You have to push. You would have to push. Otherwise, if you joke, the whole 3 hours will take that question away. So watch out. Okay, so R1 code is December 2013. Question number 2. When you go home, this is international investment appraisals. Okay, question number 1 of December 2013 is international investment appraisals. I prioritize the June 2015 over this. You can have a try on that. Same way, estimate the value of the project, the assumptions and all that, and additional business risk. Same old story. So if you've gone through one, you should be able to reasonably get reasonable marks. So this is what we're supposed to do. R1, as usual, we're going to talk about the A requirement based on the 3 hedging choices R1 code is considering. Question is very clear. 3 hedging choices. Okay, so when I go to the question, I have to go and look for those 3 hedging choices the R1 code is considering. Recommend a hedging strategy for the 48 million investment if interest rate increase or decrease by 0.9%. Support your answer with appropriate calculations and discussion. So the issue here is the 48 investment, if interest rate increase or decrease, I have to show all the 2 and I have to recommend which is the best strategy out of what the 3 choices R1 code is considering. Then B is a member of R1 code's treasury team has suggested that if option contracts are purchased to hedge against the interest rate movement, then the number of contract purchases should be determined by a hedge ratio based on the delta value of the option. Discuss how the delta value of an option could be used in determining the number of contract purchases. 6 marks. This is coming from the Greeks. Okay, this is coming from the Greeks. This 6 marks is the straightforward one. If I'm sitting down there, the B doesn't depend on the A. I will answer the B, get the 6 marks. This is 25. As I told you earlier, you needed only what? 12 and a half to pass. If I pick 5 here, I go to the B. I just need what? About 8 to cross it. That is more than enough. Don't be too greedy. Okay, if everything is okay, kill it for me. I'll be very, very happy. But you have to try and trade off. Answer the easiest one quickly out of it. Accumulate the marks and then go and push yourself a bit. But if you start pushing yourself first, by the time you come to the easier one, you are tired. Time is gone. You are a human being. You will definitely give up. Okay, so let's read here. R1 Co is expecting to receive 48 million on 1st February 2014, which will be invested until it is required for large project on 1st June 2014. Due to uncertainty in the market, the company is of the opinion that it is likely that interest rate will fluctuate significantly over the coming months, although it is difficult to predict whether they will increase or decrease. R1 Co's treasury team want to hedge the company against adverse movement in interest rate using one of the foreign derivative product, forward rate agreement, interest rate futures, or options on interest rate futures. So these are the 3 choices they are thinking of. R1 Co can invest funds at the relative interbank rate. Interbank rate is the same as the LIBOR rate, less 20 basis points. The current interbank rate is 4.09%. However, R1 Co is of the opinion that interest rate could increase or decrease by as much as 0.9% over the coming months. The following information and quotes are provided from an appropriate exchange of dollar futures and options. Margin requirement can be ignored. 3-month dollar futures, 2,000 contract size. Prices are quoted in basis point at 100 minus annual percentage yield. Examiner did well. Futures are priced at 100 minus R. Most of the questions, they don't give it to you. So you need to bring it out. December, March, June. Options on 3-month dollar futures, 2 million contract size. Option premiums are in annual percentage. Call, strike, put. December, March, June. Vablaka Bank has offered the following forward rate agreement rate to Awan Co. 1 verses 7, 3 verses 4, 3 verses 7, and 4 verses 7. It can be assumed that settlement for the futures and option contract is at the end of the month, and that basis diminishes to 0 at contract maturity at a constant rate based on monthly time intervals. Assume that it is 1st November 2013 now, and that there is no basis risk. Hedging strategies, the 3 hedging strategies we would have to actually think of, and that is what is given in here. So we have forward rate agreement, interest rate futures, or options. So first, let's go straight, and we're going to pick forward rate agreement first. So A is not a report, so freehand forward rate agreement. For whichever contract, I will need to think of which contract should I enter into. So forward rate agreement, the question here is that the forward rate agreement, this is the rate given. Which contract? Is it 1 verses 7, 3 verses 4, 3 verses 7, or 4 verses 7? The question here is, the first one, take when are you supposed to what? Transact, invest, or borrow. The period between now and the date you have to borrow. Period between now and the date you would have to borrow. What is now? According to the question, now is 1st of November 2013. And when do you want to invest? I want to invest on 1st of February. Therefore, 1st November to 1st of February. How many months? You count. November, December, January. February is 1st, so it's not part of it. So I need 3 verses. Then the second one is from now up to the time you get your investment back, or you pay the money. Here they said until the large project on 1st of June. So we will need the money from the investment on 1st of June. What is 1st of November to 1st of June? November, December, January, February, what? March, April, May is 7. So I have to enter into 3 verses 7, and I will fix the LIBOR, which is the interbank rate. Sorry, this is 3 verses 7 at the rate of 4.82. Because I am going to invest, if they have given us 2 rates, I would have to pick the lower rate. If you are going to borrow, you pick the higher rate. Here, the examiner decided to give only 1 rate, so we pick it. So I go straight and say I will enter into 3 verses 7 and fix the interbank rate at 4.82%. Okay, according to the question, I would have to do if the interbank rate increase and then when it decrease. So we're doing the increase. Currently, the interbank rate, according to the question, the interbank rate currently is 4.09%. We are expecting it to either increase or decrease by 0.9%. So when it increases, it will go to 4.09 plus 0.9. So I will say on the day of me borrowing, okay, so date of investment, what will be the rate? The rate will be 4.09% plus 0.9%, and that is 4.99%. So this is the interbank rate. Now, just as we did with the swaps, the same thing, we fix it at 4.99. I would have to go and get my actual interest from the market. So actual interest receivable, I will get 4.99, but I don't get interbank rate. This is between the banks, but I will get that plus or minus my spread. I go and ask the question, what is the rate? They said Awan Co can invest funds at the relevant interbank rate less 20 basis point, less 20 basis point. So if that is the case, I will say that I'm going to get the money at what? This minus the 20 basis point, which is 0.that%, and that will give me, is it 4.79% multiplied by, I am investing 48 million over a period of 1st February to 1st of what? Is it June? So that is going to be 4 months. So 4 over 12. And when our sum is 766, 400. This is what will happen in the main market. Then I'll have to come and activate the forward rate agreement. We fix the rate that we have to get, interbank rate. Maximum we have to receive is 4.82. But on that day we were borrowing is 4.99. We have received more than necessary. So once we have received more than necessary, what should we do? We would have to what? Compensate the bank to bring ourselves to that level. So we say compensation to bank, because what we have to receive is 4.82. So if you receive 4.99, you had received more than necessary. Pay the difference to the bank and bring yourself to it. It's an example of what we were discussing earlier. If I didn't hedge, I would have been better off, isn't it? But here, I hedge it and put it at 4.82. That is the maximum. So I will say 4.99% minus 4.82%. multiplied by 48 million, multiplied by 4 over 12. I am going to pay this to the bank, and that is 27,200. So this is the net amount I will receive. This is the net amount I will receive, and that is 739,200. Okay, so that is basically the first one. What about if the interbank rate were decrease? We're following the same process. So interbank rate decrease by that 0.9. So what is the rate at date of investment? Okay, currently is 4.09%. is decreasing by 0.9%, and that should bring you to 3.19%, isn't it? And then what next? I have to get my actual interest. I have to get the actual interest. My actual interest is the LIBOR or interbank rate is 1.9%, but I do get the interbank rate minus 20 basis point, and then multiply by 48 million, multiply by the period of me what? Investing. And how much is this calculation supposed to be? 478412. 478420. Then I need to activate the forward rate agreement. I need to activate the agreement. What happened? We fixed the rate at 4.82%, but on the day of me going to invest, the rate is 3.19. I received less than what I was supposed to receive, so the bank should top me up to bring me to this point. So I will say compensation from bank, and that is simply the 4.82% minus 3.19%, all multiplied by 48 million, multiplied by the period of borrowing, and that is 260,800. So when I sum it up, it should bring me to the same thing, because whatever the rate will be, I have fixed it at this. Either I am receiving compensation or I am paying compensation. All of them will bring me to that. The fastest way, which ACC doesn't want you to do that, would have been I fix it at 4.82%, but I don't get interbank rate. I get the interbank rate less the 20 basis point. So that would have been 4.62%. Multiplied by 48 million, multiplied by 4 over 12 will bring you that figure that you get as the net. So this is the simplest way of doing that, but ACCA want you to show the outcome. So this is basically the case. This is basically the case. Now let's go to the next. The next that we can use to do is the interest rate futures. So interest rate futures, this is the information given about the interest rate futures. Your first question is, which contract should we enter into? The contract we have to enter into should be the contract that will mature immediately after your transaction date. My transaction date here is the day I would have to invest or borrow. I want to invest the 48 million on 1st of February. So if my transaction date is 1st of February, which of these contracts here will be maturing immediately after the 1st of February? If I come here, I see March contract. Therefore, I have to enter into March contract. This mark, it should be for you. So I will say the futures interest rate futures. I will say that I will enter into March contract because it expires immediately after my transaction date, which is 1st of what? February. Do you have to enter by buying or selling? If you have listened to the lecture, the videos, we said that here I can stereotype it for you. If it is interest rate and you are going to what? Invest, then your worry is for interest rate to what? Decrease. So you are going to hedge against decrease in interest rate. So you enter by buying, isn't it? So that when interest rate increase, you close it by what? Selling. So you will say when you are going to invest, you enter by buying as interest rate is expected to decrease. If you are going to borrow, your worry is interest rate will increase. So you sell it now, and then when interest rate increase, you buy it cheap, isn't it? So they turn it, the calculation upside down. So watch out. So when you are investing, here I can stereotype, enter by. You are confused about I'm confused about the compensation from the bank. Okay, the compensation from the bank, this is it. The argument is you fix the interbank rate at 4.82%. That whatever the interbank rate will be, you have to receive 4.82. But on the day you invested, the interbank rate had decreased from this by the 0.9 to 3.19. So if it's gone to 3.19, you will receive 3.19 from wherever you invested. But you've also entered into agreement with another bank that you have fixed the rate at this. So the minimum interbank rate you were supposed to receive is the 4.82. But how much did you receive? You received 3.19. So you receive less than what you ought to have received. So the other bank that you entered into agreement, you just call them and you tell them something. What we agreed is that the interest I have to get interbank rate should be 4.82, but the interest I got is 3.19. So you would have to bring me to 4.82. So I have to get money from them. Same way, compensation to the bank. What happened? The compensation to the bank, you agreed to get a maximum of 4.82. But on that day, you got 4.99. The bank will also call you, Fred, come here, you know something? Because we agreed at 4.82 and you went and received 4.99, you would have to pay me something. That will bring you from 4.99 to what? 4.82. So this is compensation payment to what? Bank. And the other one will be from the bank because you received less than what you agreed. So the bank should top you up. The same way, if you had received more than what we agreed, then you have to pay back to bring you to what we agreed. So that is all what we're doing here. Okay, so there we agreed 4.8. Brilliant. And now we got 3.19. So that difference I have to be topped up by the bank. Okay, so let's come back. If it is interest rate futures, enter into the contract that matures immediately after the transaction date. And then if it is investing, enter by buying and close by selling. The next one is you have to calculate number of contracts. You have to calculate number of contracts. And the number of contracts that you need to calculate, if you have followed the lecture, we said that when you come to interest rate and you have to calculate the number of contracts, you would have to pause and ask a question. And that question is there any maturity mismatch? Is there any maturity mismatch? What do I mean by that? Futures is in a cycle of 3 months, 3 months. So its assumption here is that you are going to borrow in a cycle of 3 months, 3 months, or you are investing in a cycle of 3 months, 3 months, 3 months. But because interest rate is expressed per annum, are you technically going to borrow or lend over a period of 3 months? Given this question, we are borrowing or investing at a 4-month period, but the normal futures is like you are borrowing or investing notionally 3 months. So that 3 months does not coincide with our actual investing period. That is why we said the maturity of our investment is not the same as the maturity of the futures, because future is 3 months, 3 months, and our investment maturity is 4 months, 4 months. So those two maturities are not matching up, and that is what is called maturity mismatch, and you need it in the calculation of the number of contract. So that number of contract is how much are we investing. We want to invest 48 million, and then contract size in the question is that it is given contract size of 2 million. So I will say this is the 2 million. This 2 million is in a cycle of 3 months, but this 48 million you are going to invest it over a period of what? 4 months. This is what is explaining the maturity mismatch and how many number of contract. So please, when you are about to calculate number of contract and futures, watch out for the maturity mismatch. If your period of borrowing or investing does not match with the 3 month normal cycle, if you go to the question, you will see that they said they didn't even say here. Normally the question would have told you that they said it here, 3 month dollar futures. It means this is giving you the obligation to either lend or borrow for a period of what? 3 months. But we are not borrowing. We are not investing over 3 months. We are investing over 4 months. So the maturities are not the same. So you need to make that adjustment. That is why you would have to watch out for the maturity mismatch. And then how much number of contract we're going to get, which is 32 contracts. So that is the 32 contract. And unfortunately, even though we can use the lock-in rate to here, when it is interest rate, ACCA is expecting us to do all of that. So we have to calculate the profit or loss. And we have to do it when the interest rate increase and when the interest rate also what? Decrease. Okay, we said we are entering into the contract by buying. Which futures contract did we enter into? And we will close by what? Selling. And these two will give us the profit or loss. Okay, so buying, what is the futures price now? We pick the March contract, and the March contract future price today is 94.76. So I will say 94.76, 94.76. I need the closing price. This is the March contract price as at 1st of what? The November. But I will close it as at 1st of what? February. So what is the March contract price as at 1st of February? This is as at 1st of what? November. It's not going to stay as it is. It's going to move. Okay, so we need to calculate the closing price. You leave a space here and then you go and calculate the closing price. The closing price should be calculated based on what is called basis and basis risk. So I have left a space in there. 1 minute. Okay, so I go down here and I'm going to calculate my closing price using basis and basis risk. Okay, so we're going to say that my closing price is calculated as, let me give it to you straight. The closing price is calculated as the LIBOR, which is the same as interbank rate, plus or minus the unexpired, plus or minus the unexpired word basis. And we've seen the unexpired basis as the basis now, which is the spot rate. So the spot rate is going to be the LIBOR again minus the futures price. We've seen the formula when we were doing the exchange rate, divided by period from now to maturity, multiplied by period, okay, from transaction date to maturity. Watch out, it's slightly different from the lock-in rate. The lock-in rate is not LIBOR here. It's not the spot rate. The lock-in rate, this would have been the future price. Watch out with the difference because people tend to mix them together. So currently, what is the LIBOR? The LIBOR here should be the LIBOR as at the transaction date. At transaction date. And then this is the current LIBOR. Let me be very careful with that. So my LIBOR as at the transaction date is going to be dependent on whether the interest rate increase or interest rate decrease. So when interest rate increase, what was the interbank rate? If you remember from the forward rate agreement, we said the interbank rate when it increased is 4.99 and prices are calculated as, so that my LIBOR of the 4.99 will be 100 minus 4.99%. Don't forget it's 100 minus the R. So I'm going to get 100 minus 4.99, which will give me 95.01. And then, okay, if it decrease, what will be the LIBOR? Is going to be 100 minus 3.19%. So 100 minus 3.19% is 96.81. I have got this. Now I need the unexpired basis. The moment I do that, that one doesn't matter. Whether it is increasing or decreasing is the same. So what is the LIBOR now? The LIBOR now, if you remember, they said is 4.09. So I'm going to get 100 minus 4.09, which will give me 100 minus 4.09, and that is 95.91. And the futures price that we pick, the March contract, is supposed to be given as 94.76. So I come back 94.76 divided by the period from now up to maturity. Now is 1st of what? November. We picked March contract. March contract will mature at the end of March. So what is the period from 1st November to end of March? So November, December, January, February, and March is 5 months. I divide by 5. multiplied by what is the period from the transaction date, the date we are investing, which is 1st of what? February, up to the maturity, end of March. Is it 2 months? And as such, what is the figure? The figure here, let's resolve it. 95.91 minus 94.76 divided by 5 times 2, and that is 46. So here would have been 95.01 minus 0.46, and the figure is minus 95.01. This is giving 94.55. So when it increased, the closing price will be 94.55. When it decreased, it's 96.81 minus 0.46. That same thing. So 96.81 minus 0.46, and that is 96.35. So having got the closing prices when it increased and decreased, I should be able to calculate my profit or loss. So let's go up and have a look at that. So I bring myself up here. The only challenge is how to calculate the closing price. And please look at it. The only challenge is this. So when I get these closing prices, this is 94.55 when it increased, and this is 96.35 when it decreased. So have I made a profit or loss? When interest rate increase, I bet wrongly, because my assumption was interest rate will decrease, so that if I'm investing and it decrease, I'm going to be in trouble. So I bet or I hedge on the basis of interest rate decreasing. So should interest rate increase, I would have to make a loss. That is why I'm making a loss here. I will buy it at 94, sell it at that. I have got an obligation. So 94.76 minus 94.55 will give me 0.21 percent, and then 94.76 minus 96.35. This is giving me a profit of 1.95%. What then will be my total profit or total loss? What then will be the total loss here? Okay, for this is a loss, for that is a profit. For profit to be calculated, you will get your, if you want to go by the long way, this is percentage. I will say 0.21% multiplied by each contract size is 2 million multiplied by a period of 3 months cycle, and then multiply by the number of contract. We said there are 32 contract. So 0.21 divided by 100 times 2 million, times 3 divided by 12 times 32, that is given 33,600. Somebody could have used a tick approach. And if I'm using the tick approach, if you remember, you have to shift this one by 100. It will give you 21 multiplied by the number of contract, which is 32. The tick value for the 2000 contract size is given as what? 50. You can stereotype it. If it is 500 contract size, it's 12.5. If it is 1 million, multiply by 2 to be 25. If it is 2 million, 12.5 times 4 times will give you what? 50. And that will also have given you 33,600. This is the fastest. So when I also want my total profit, I will say the total profit will be, I'm going the short way. I will shift that one twice, get 159, multiply by the 32, multiply by the 50. If you put this one there, you come back to the same answer. 159 times 32 times 50 will give us 254400. The moment I get the profit or loss, I look at the net outcome. So what will be the net outcome? What will be the net outcome? I have to do when it increase, and I have to do when it decrease. Okay, so I will say what is the actual interest? our actual interest. We've done it already. So when you go up there in the forward contract, the actuals, when interest rate was increasing, we said the interest we will actually get is that. When interest rate was decreasing, we said this is what we will get. So that one doesn't matter. That is what we have to pay in the market. So when it was increasing, it's 766,400, and this is 478,400. Then we come and activate the futures contract. When interest rate increased, we made a total loss of 33,600. So we say the futures is sort of a compensation, either we are paying or we are receiving again. Okay, right. How did we get the tick value? Let me show you. Tick value is calculated as the contract size multiplied by 3/12 multiplied by 0.01%. So if the contract size is 2 million, I will multiply by 3/12 multiplied by 0.01%, and that will bring you to 50. Okay, so that is what I normally tell students in the exam room. Can you go and cram all this? If you can cram this, then it will be easier. The tick value of 500,000 contract size is 12.5. So if the examiner give me 1 million, I am multiplying this by 2. This one should bring me to 25. If you give me contract size of 1.5 million, I will multiply this by 3. If you give me 2 million, I will multiply it by 4. And that is how I got the 50. Brilliant, Clark. So that is the argument in there. Okay. So let's come back. So let's bring the futures. Here we made a loss of 33,600, and there we made a profit of 25,4400. When you sum them up, all the two should be the same, because the futures will also lock in the red. That's why we could have used the lock in red. So when you sum, this is 732,800, 732,800. So I am going to stop it here because our time is up. When I see you next week, I will do the options, and then we do the delta, and we take it from there. So thank you very much for your time this evening, and I'll see you next week for the option bit, and then we'll talk about the Greeks, which is the delta, and we move on to measures and acquisitions, and then other aspects. So thank you very much for this evening, and any question that you have, you can send them to me through the email. Good night.